there's a question that once you truly understand it, changes everything you thought you knew about money, economics, and wealth. If the Federal Reserve creates money out of thin air, who do they owe it to? Think about that for a moment. When you or I borrow money, we owe it to someone. The bank, the credit card company, whoever lent us the money. But the Federal Reserve doesn't borrow money from anyone. They create it. They literally type numbers into a computer, and those numbers become dollars that didn't exist seconds before. So if they're creating something from nothing, who's the creditor? Who are they obligated to pay back? The answer to this question reveals the most profound truth about our monetary system, a truth that most people never discover because they never think to ask the question. I'm Cathie Wood, and I've spent my career studying disruptive innovation, economic cycles, and how financial systems really work beneath the surface narratives. And what I'm about to explain to you is probably the most important economic concept you'll ever learn, because understanding this changes how you think about inflation, about debt, about taxation, about wealth itself. The Federal Reserve creates trillions of dollars. In 2020 and 2021 alone, they created approximately $6 trillion. Just created it. Out of nothing. And every one of those dollars says Federal Reserve, note at the top. A note is a debt instrument. It represents money owed. So the question stands, if the Fed creates dollars out of nothing, and those dollars are technically debt instruments, who is owed what? The answer is both simpler and more disturbing than most people imagine. Let me start by walking you through what actually happens when the Federal Reserve creates money, because the mechanics of this process are deliberately obscured in complexity. Most people think the government prints money. That's not accurate. The Treasury prints physical currency, but physical currency is only about 10% of the money supply. The vast majority of money exists only as digital entries in computer systems. And that money is created by the Federal Reserve through a process that sounds like it should be illegal, but isn't. Here's how it works in practice. The United States government needs to spend money. Congress passes a budget that requires, let's say, $5 trillion in spending. But tax revenue is only $4 trillion. So there's a $1 trillion deficit. Where does that $1 trillion come from? The Treasury Department issues bonds. These are IOUs from the government, promises to pay back the money with interest over time. These bonds get auctioned to whoever wants to buy them. Foreign governments buy some, pension funds buy some, banks buy some, and the Federal Reserve buys some. Now, here's where it gets interesting. When the Federal Reserve decides to buy, let's say, $500 billion worth of these bonds, where do they get the $500 billion? You might think they have money saved up, that they collected it from somewhere, from taxes maybe, or fees, or profits from previous operations. No, they don't have it. They create it in that moment. I want to be very clear about this because it sounds so absurd that people often don't believe it the first time they hear it. The Federal Reserve literally creates the money they use to buy government bonds. They don't transfer it from an existing account. They don't withdraw it from reserves. They create new money by making an electronic entry that credits the Treasury's account. One moment, that $500 billion doesn't exist. The next moment, it does. Because the Federal Reserve typed it into a computer. This is called quantitative easing or open market operations, depending on the specific mechanism. But the result is the same. New money created from nothing. Now, if you or I did this, it would be counterfeiting. It would be fraud. We'd go to prison. But when the Federal Reserve does it, it's monetary policy. It's how the system is designed to work. This raises the obvious question. If they can just create money whenever they want, Why do we pay taxes? Why does the government borrow at all? Why not just create all the money needed? And that question leads us to the deeper truth about what money actually is and who controls it. The Federal Reserve is not a government agency. This is crucial to understand. Despite the official sounding name, despite the fact that the president appoints the board members, the Federal Reserve is a private banking cartel. It was created in 1913 by an act of Congress, but it was designed by bankers for the benefit of bankers. The Federal Reserve System consists of 12 regional Federal Reserve banks. The most important is the Federal Reserve Bank of New York, because that's where all the actual money creation happens. These regional banks are not government entities. They are private corporations, and they have shareholders. Who are the shareholders? Commercial banks. JP Morgan Chase owns shares in the New York Fed. So does Citibank, Bank of America, Goldman Sachs, all the major banks. These banks are required to buy shares in their regional Federal Reserve Bank as a condition of membership in the system. And those shares pay dividends. By law, the Federal Reserve must pay member banks 6% annually on their shares, guaranteed, risk-free, before any profits go to the Treasury. So we have a private banking cartel that has the legal authority to create unlimited money, and that cartel pays dividends to its member banks, who are the largest financial institutions in the country. Let that sink in for a moment. The power to create money, which should be the most important sovereign power of any nation, has been outsourced to a private banking system that profits from exercising that power. This is not a conspiracy theory. This is documented in the Federal Reserve Act. You can read the law. You can see the ownership structure. It's all public information. It's just not widely understood. Now, back to our original question. If the Fed creates money from nothing, who do they owe it to? The answer is nobody. The Fed doesn't owe the money to anyone. They created it. It's theirs to create. There's no creditor standing behind them demanding repayment. But here's the trick that makes the whole system work. The government owes the money to the Federal Reserve. When the Fed creates $500 billion to buy Treasury bonds, they're not giving that money to the government. They're lending it to the government. The government receives the $500 billion to spend. But now the government owes $500 billion plus interest to the Federal Reserve. And where does the government get the money to pay that interest? From taxes, from you. So the chain of obligation goes like this. The Federal Reserve, owned by private banks, creates money from nothing. They lend that money to the government. The government pays interest on that loan. The interest comes from tax revenue. And some of that interest flows back to the banks that own the Federal Reserve. Money flows from your paycheck through taxes to the government, to the Federal Reserve, to private banks. That's the wealth transfer mechanism built into the core of our monetary system. Now, you might ask, doesn't the Federal Reserve send most of its profits back to the Treasury? Doesn't that offset the interest payments? Yes and no. The Federal Reserve does remit profits to the Treasury. In 2023, they sent about $56 billion to the Treasury. But let's look at the full picture. The Federal Reserve holds approximately $5 trillion in Treasury bonds on its balance sheet. Those bonds pay interest at an average rate of around 2 to 3%. That's 100 to 1. $150 billion in interest income per year. The Fed's operating expenses are about $5 billion per year. They pay dividends to member banks of about $2 billion per year. They keep some for capital reserves, and they send the rest to Treasury. But even if they're sending profits back to the Treasury, the fundamental dynamic remains. They created money from nothing. They're collecting interest on it, and that interest is being paid by taxpayers. It's like if I had a magic printer that could create legitimate $100 bills, and I used that printer to create $1 million, which I lent to you at 5% interest. Every year, you'd owe me $50,000 in interest. Now, I might be generous and give you back 40,000 of that 50,000. But I still created the million from nothing, and I'm still collecting net interest on it. That's essentially what the Federal Reserve does, just with much larger numbers. Now, let me explain why this matters for inflation, because this is where most people's understanding breaks down. Inflation is not caused by greedy corporations raising prices. That's a symptom, not a cause. Inflation is not caused by supply chain disruptions, though those can contribute. Inflation is not caused by workers demanding higher wages. Inflation is caused by one thing: an increase in the money supply relative to goods and services available. When the Federal Reserve creates $6 trillion in 2 years, as they did in 2020 and 2021, they're increasing the money supply dramatically. More dollars chasing the same amount of goods means each dollar is worth less. That's inflation. It's not complicated, it's math. But here's what makes this particularly insidious. Inflation is a hidden tax. When the government increases income taxes, everyone notices. People complain. Politicians face consequences. There's democratic accountability. But when the Federal Reserve creates money and that money causes inflation, it's a tax that most people don't even recognize as a tax. Your salary might stay the same nominally. You still earn $50,000 a year. But if inflation is 7%, the real purchasing power of that 50,000 is declining by 7% annually. You're getting poorer, but your paycheck looks the same, so you don't fully realize what's happening. Meanwhile, who benefits from this inflation? The people and institutions that are closest to where the new money is created. When the Federal Reserve creates money, it doesn't drop it from helicopters evenly across the country. It enters the financial system through banks, through government spending, through Wall Street. And the people and institutions that receive this new money first get to spend it before prices rise. They benefit from the new money at the expense of everyone else who receives it later, after prices have already increased. This is called the Cantillon effect, named after an 18th century economist who first identified it. The Cantillon effect explains why wealth inequality has been increasing so dramatically since 2008, because since 2008, the Federal Reserve has created approximately $8 trillion. That money flowed primarily to financial institutions, to large corporations, to asset holders. It inflated stock prices, real estate prices, bond prices. If you owned assets, you got richer. If you didn't own assets, you got poorer in real terms because your wages didn't keep up with the asset price inflation. This is not a bug in the system. This is how the system is designed to work. It transfers wealth from wage earners to asset owners, from the middle class to the financial class. And it happens through a mechanism that most people don't understand and therefore can't effectively oppose. Now, let me address the national debt, because understanding monetary creation explains why the debt can never be repaid. The United States national debt is currently about $36 trillion. It increases by approximately $2 trillion every year. People talk about paying down the debt, about fiscal responsibility, about balancing the budget. But here's what they don't tell you. In our current monetary system, the debt cannot be paid off, not without destroying the money supply. Let me explain the mathematics of why this is true. Every dollar in circulation was created when the Federal Reserve bought debt, mostly government debt, but also other assets. When the Fed buys a treasury bond, they create dollars. Those dollars enter circulation. That's how the money supply expands, which means every dollar that exists represents debt that someone owes to the Federal Reserve or to the banking system. If you add up all the dollars in circulation, that number roughly equals the total debt in the system. Now, imagine the government decided to pay off the entire national debt. They would need to collect dollars through taxation. They'd take those dollars and give them back to whoever holds the Treasury bonds, including the Federal Reserve. When the Federal Reserve receives dollars in payment of bonds, what happens to those dollars? They're destroyed. They disappear from the money supply. Because remember, the dollars were created when the Fed bought the bonds. Paying off the bonds reverses that transaction. So if the government paid off the entire $36 trillion national debt, $36 trillion would be removed from the money supply. There would be almost no money left in circulation. The economy would collapse instantly. This is why the national debt has increased every single year for decades. It's not just fiscal irresponsibility, it's a mathematical requirement of the monetary system. As the economy grows, you need more money in circulation. The only way to create more money in this system is for someone to go into debt. Usually that someone is the government, because they're the only entity large enough and stable enough to continuously borrow trillions. The system is designed to require ever-increasing debt. It's not a bug. It's the fundamental architecture. But it gets worse. The interest on the debt is not created when the principal is created. When the Fed creates $500 billion to lend to the government, only $500 billion enters the money supply, but the government owes $500 billion plus interest, let's say $15 billion per year. That $15 billion wasn't created. It has to come from dollars that already exist, which means someone else has to go into debt to create those dollars, or the government has to borrow more, which creates more interest obligations. It's an exponential trap. Every new dollar of debt created generates interest obligations that require more debt to service. The math literally cannot work in the long run. The debt will always grow faster than the money supply because interest compounds, but money supply growth is linear at best. This is why I believe we're heading toward a monetary reset at some point in the coming decades. Not because I want it, but because the math demands it. The current system is unsustainable. When you create a monetary system where debt must grow exponentially and can never be fully repaid, eventually you reach a breaking point. That breaking point might be a currency crisis, it might be hyperinflation, it might be a debt jubilee, it might be a transition to a new monetary system entirely. I don't know exactly what form it will take, but I know the current trajectory cannot continue indefinitely. Now, let me talk about what this means for innovation and for investors, because this is where my expertise really comes in. Understanding that we live in a system of perpetual monetary expansion changes how you should think about investing. In a sound money system where the money supply is stable or grows slowly, you can store wealth in currency, you can save money and expect it to hold its value. But in our system, where the money supply is constantly expanding, holding currency is guaranteed to make you poorer over time. This is why interest rates exist. Interest is supposed to compensate you for the loss of purchasing power caused by monetary expansion. If inflation is 3%, interest rates should be at least 3% just to break even in real terms. But what happens when the Federal Reserve holds interest rates below the inflation rate, which is what they did for over a decade after 2008? You get negative real interest rates, which means savers are being punished. Anyone holding cash or government bonds is losing purchasing power. This forces everyone into riskier assets, into stocks, real estate, commodities. anything that might hold value against monetary expansion. This is what drove the everything bubble we saw from 2008 to 2021. Stocks, bonds, real estate, crypto, all rising together because the Fed was creating money faster than the economy was growing. The money had to go somewhere. It flowed into assets. Now, as an investor who focuses on disruptive innovation, I see this as creating both enormous opportunities and enormous risks. The opportunity is that innovation companies, companies working on transformative technologies, can access capital more easily in this environment. When the Fed is creating trillions of dollars and pushing people into risk assets, innovative companies can raise funding, scale rapidly, disrupt incumbent industries. This is why we've seen such explosive growth in areas like electric vehicles, genomics, artificial intelligence, blockchain technology. Abundant cheap capital flowing into innovation has accelerated technological progress. But the risk is that this abundance of capital also creates bubbles. It funds companies that shouldn't exist. It pushes valuations to unsustainable levels. And when the bubble pops, when monetary conditions tighten, all that excess gets wrung out of the system painfully. We saw this in 2000 when the dot-com bubble burst. We saw it in 2008 with the housing bubble. And we're seeing elements of it now as the Fed has raised rates to combat the inflation they created. So as an investor in this environment, you have to be very selective. You can't just buy anything and expect the rising tide of monetary expansion to lift it. You have to identify truly disruptive innovations, technologies that will create real value regardless of monetary conditions. Because when the monetary tide goes out, only the companies with real substance will survive. This is why at ARK Invest, we focus so intensely on fundamental innovation analysis, on understanding which technologies will actually transform industries. Because in a world of monetary manipulation and artificial bubbles, fundamental value creation is the only reliable anchor. Now, let me address what I think is coming next, because understanding monetary mechanics gives you insight into future policy. The Federal Reserve is trapped. They created massive inflation through money printing in 2020 and 2021. Now they're trying to combat that inflation by raising interest rates and reducing their balance sheet. But raising interest rates when the national debt is $36 trillion creates an enormous problem. The government has to pay interest on that debt. Higher rates mean higher interest payments. In 2024, the federal government will pay over $1 trillion in interest on the national debt. $1 trillion. Just in interest. Not paying down principal, just interest. That's more than we spend on defense, more than we spend on most domestic programs. And as rates rise and debt grows, that interest bill will rise with it. At some point, probably within the next 5 to 10 years, interest on the debt will become the single largest federal expenditure. When that happens, the government will face an impossible choice. Either default on the debt, which would destroy the dollar's reserve currency status and crash the global financial system, or monetize the debt by having the Fed create money to buy the bonds, which would create massive inflation. Neither option is good, but my prediction is they'll choose inflation over default, because inflation, while painful, is politically easier to manage than outright default. With inflation, the government can claim they're fighting for the people against greedy corporations. With default, there's no scapegoat. It's just the government admitting it can't pay its bills. So I expect we'll see cycles of this over the coming years. Periods of tightening followed by periods of massive money creation. each cycle pushing the system closer to its ultimate breaking point. For investors, this means you need to own real assets, things that hold value against monetary debasement, innovation-driven equities, companies that are creating real value through technological advancement, real estate in desirable locations, commodities, energy, Bitcoin, and other scarce digital assets that can't be inflated away by central banks. The worst thing you can do in this environment is hold large amounts of cash or long-term government bonds, because those are guaranteed losers against monetary expansion. And let me return now to our original question with the full context of everything we've discussed. If the Federal Reserve creates money from nothing, who do they owe it to? The complete answer is this: the Federal Reserve owes nothing to anyone. They are the creators of money. There is no debt they bear. But the government owes everything to the Federal Reserve, and by extension, you owe it because your tax dollars pay the interest. This is the fundamental asymmetry built into our monetary system. The creators of money owe nothing. The users of money owe everything. The Federal Reserve can create unlimited money to bail out banks, to buy government debt, to manipulate interest rates, to pursue whatever policy goals they choose. But you cannot create money. You must earn it, borrow it, or receive it through some transaction. This asymmetry creates a system where wealth flows upward from those who must earn money to those who can create it. It's not capitalism. It's not a free market. It's a system of monetary privilege that benefits insiders at the expense of everyone else. Now, I want to be clear about something. I'm not saying the people at the Federal Reserve are evil or malicious. Most of them genuinely believe they're doing what's best for the economy. But the system they operate within is fundamentally flawed. It creates perverse incentives. It enables the transfer of wealth from savers to debtors, from wage earners to asset holders, from the productive economy to the financial economy. And it's unsustainable in the long run. What do I think the solution is? I think we need to return to sound money principles, money that cannot be created at will by centralized authorities. This could take several forms. It could be a return to some kind of commodity-backed currency, though I doubt that's politically feasible. It could be a transition to decentralized digital currencies like Bitcoin that have programmatic limits on supply. It could be a complete restructuring of the Federal Reserve System to remove the private banking control and return money creation power to democratically accountable institutions. I don't know exactly what the solution will look like, but I know the current system is reaching its limits. When you understand how money is really created, when you understand who controls that creation, when you understand who benefits from it, you can't unsee it. You realize that so much of what we're told about economics is narrative designed to obscure the reality. We're told the national debt is a burden on future generations. But really, it's a wealth transfer mechanism to current financial elites. We're told inflation is caused by supply shocks or wage growth, but really it's caused by monetary expansion. We're told the Federal Reserve is independent and acts in the public interest. But really, it's a private banking cartel that serves the interests of its member banks. Once you see through the narrative to the mechanics underneath, everything changes. You make different investment decisions, you vote differently, you think differently about economic policy, and that's why this question, who does the Fed owe money to, is so important, because the answer reveals the entire architecture of our monetary system. And once you understand that architecture, you can position yourself to navigate it successfully. You can protect your wealth from monetary debasement. You can invest in innovations that will thrive regardless of monetary manipulation. You can prepare for the eventual reset that mathematics demands. The question isn't whether the current system will change. It must change. The math requires it. The question is whether you'll understand what's happening in time to position yourself accordingly. That's why I spend so much time thinking about monetary mechanics alongside technological innovation, because the two are intimately connected. The monetary system shapes what innovations get funded. It shapes which companies succeed and which fail. It shapes the entire economic environment in which innovation occurs. And understanding both the innovation side and the monetary side gives you a massive advantage as an investor and as a thinker about the future. So when someone asks me if the Fed prints money, who do they owe it to? I see it as an opportunity to explain the entire system, to show how money creation works, who controls it, who benefits from it, and why it matters for your financial future. The Fed owes nothing, but you owe them through the taxes that pay interest on government debt created by money printing. That's the truth they don't teach in economics classes. That's the reality behind the narrative, and now you know it.